Enzo DiCascenzo podcast. This is our part 2 introductory video for the fall 2023. So for all my classes, St. Peter's and JCU, and of course, our friends in the European Union, checking out some of these videos too. This is for all, covering the spectrum of an audience with these videos. So certainly we're going to talk about very timely topics and what's going on now. Okay, that's what I can do. I can talk about what's going on now. That's what I care about discussing with you guys, making it worth your time. So let's get right to it. Okay. So I posted the first video, which talked about Jeremy Grantham, and actually what I did for you guys. I'll just show you one of them. Yeah. So waiting for the last sentence. These are his papers. I posted these under the readings on Blackboard. If you go to Blackboard, there's 3 Jeremy Grantham publications, or his technical paper, his I would say analysis of the market, or his, let's say, his commentary. There's 3 PDFs of that: the hazards of asset allocation in a late stage major bubble. And actually, really, I really appreciate and almost want to demand your questions, in the sense that you really do make me think about things, which is why I keep fighting the traffic to get to Jersey City a couple times a week. See what says, how do asset bubbles cause recession? We have a very nice discussion here. What happens when the market is in a bubble? What happens when financial bubbles burst? How do bubbles affect the economy? Okay, so we're going to go through unmanageable debt, and really, I know what's in the economics textbook, the content, the academic content, and we find the personification of that today, not in 1965 or whenever, today. Okay, so that's what I'm selling up here. Okay, so we're talking about the impact of it today. Losses. Actually, looking at this can create trigger. Yeah, a little bit cleaner, a little bit better version of that. So how do bubbles affect the economy? What happens when financial bubbles burst? What happens when the market is in a bubble? And here's the thing with this: people, for whatever reason, and look, I'm a product of NJIT and Rutgers and Fordham and all these different places, Queens College, and I know the deal in the universities. You get into the it's like the monastery, right? You get in the silo of the walls, and that's all that sort of exists. It's even somewhat of an echo chamber in a way. I'm out in the world. Okay, I would have met the people that I met, or had the relationships with the people that I have the relationships with, if I didn't get on a plane and go overseas and go here and go there and go to dinners and those types of things. Okay, I wouldn't have had the relationships that I have. So I'm very sort of happy to have done that. And I want to say to you guys, you're not going to meet anybody in your office, right? Okay, you're not. Okay, you got to go out into the world and see what's going on. Okay, that's an important. I would try to get rid of the authors. Oh, this sounds Japanese, actually. The guy who wrote this, but this says Warren Buffett's secret sauce involves one of investing's most basic strategies. I think this is Wall Street Journal. Yeah, this is Wall Street Journal. It's funny. I remember when I saw this, we were on a conference call and we were delayed for whatever reason from someone for quite a while. And I was just sitting there waiting for the call to start, and I flipped across this, and actually it stuck in my mind as I was doing that. So it says, what has made Warren Buffett's stock portfolio so successful over time? Warren Buffett is not a currency trader. He doesn't care about exchange rates, and really, I know there's a couple people in my international finance class who have a lot of questions about, what's in the textbook and what we're talking about. Folks, my 6 projects are all international. They're all in the euro. They're not in, in euro currency, not in US dollars. We're going to transfer from dollars into euros, but that exchange rate, and actually, as we're talking about it here, let's just quickly take a look at it. It's not that we're not making the transaction that we're making because of the exchange rate. Now, there's people who are traders. There are people who are currency traders. But, folks, let me tell you, you've got to have a big amount of capital to do that, because look at the variation. €1 equals $1.08, and another way is a dollar buys only 0.93 euro, kind of a thing. So you can see it's not that dramatically. You're talking about an 8% difference in these currencies. So it's not that big of a change. And you could see in the day, anything really, the S&P 500, any of these exchange rates, or how the percentage change in the S&P 500 or something, the Dow Jones, if it's more than about 0.5%, if it's 0.5% change from the previous day or more, you'd say that's very. If it's a percent change, a 1.5% change, that's a lot for one day for an index, and even for currency exchanges. You can see that the dollar and the yen, the euro, and see. There's euro to the US dollar, and then there's US dollar to euro. Which one's getting stronger? Which one's getting weaker? Let's look at the 5-year version of this. Okay, so if we look at this, this is €1. Okay, so here let's look at it at the perspective of somebody in Europe. Okay, at one time you could buy $1.20 worth of US goods for €1. This is December 3rd, 2020, and here €1 only buys 0.97 US dollars of US goods. So obviously the euro is weakening and the dollar is strengthening, right? The dollar is strengthening because you can't buy as much of it any longer. I'll say that one more time. Okay, looking here, December 2020, €1 would buy a lot of US goods, $1.22 worth of US goods. Recently, and here you can even look recently, even if it's $1.10 or $1.12, and it used to be $1.20. Now you're only can buy $1.10 worth. So it's almost counterintuitive, where as you're looking at this currency exchange graphic, as you're moving along the axis, you figure as you go up or down, if you go higher, it's better. If you go lower, it's maybe not as good. But you have to understand, what's appreciating and what's depreciating. Okay, so when you have one, again, just repeating it, €1 a couple of years, 3 years ago would buy $1.20 worth of US goods. Recently, as of Christmas or whatever, it would only buy $1 worth. It was 1-to-1 practically, as opposed to $1. So in other words, you're buying 20% less. From the European perspective, you're buying 20% less goods. So the euro was weakening and the dollar was strengthening. Okay, that's how you look at that. And again, are you talking about the euro? Are you talking about the dollar? So here's our little currency exchange analysis here, which so many people seem to care about, the first week of school. Okay, which is that situation. So here, let's flip these. Okay, we're still now. This is the mirror image now. So now this is one again. So this is us sitting in New York or sitting in California, and we're buying something from France. We're buying something from a country that uses the euro. Okay, I would say at one point the dollar would buy 0.9 euro of goods, or whatever it might be, 0.93 or 0.9. And then here, the end of 2022, the dollar bought a whole $1 bought €1, as opposed to $1 buying 90% of a euro. So in other words, our dollar strengthened in this situation. So if our currency buys more of some other country's currency, and when I say some other country, that's some other country's goods. So if we buy cars or commodities or batteries or some sort of minerals or materials or lumber or wheat or whatever it might, or cotton or something, whatever it is we're going to get from some of the petroleum products. So in other words, our dollar goes further, so the dollar is strengthened and the euro has weakened. In the same 2020 to last Christmas sort of analysis. Now it's sort of receded a bit. There's some sort of, the 1-to-1 is really what the world sort of wants. Okay, that's always sort of the goal. Okay, is that a dollar of European, a dollar euro, €1 and $1 US is equivalent. There's the petroleum producing countries don't let their currencies fluctuate at all, because it would impact the petroleum markets, and then you'd have even more hedging and even more speculation, not just on the price of oil, but on the exchange rate. So you have two vectors to deal with instead of one. Okay, which makes it certainly much more complicated to deal with situations like that. Okay, but that's why some of the like the UAE and maybe even Saudi Arabia, they don't let their currency compared to the U.S. dollar vary because we're still the global currency in the world. Okay, but that was a little discussion about a stronger currency and a weaker currency. So if our currency buys more of some other currencies, some other countries' currency, some other countries' goods, our dollar has strengthened. If $1 buys less, our U.S. dollar has weakened. Okay, so in this particular situation, again, one U.S. dollar a couple of years ago was buying, zero point 0.8 euro. Now we're buying over an entire euro or more. Now it's back to 0.9, but even 0.8 versus 0.9 is still about 10%. Okay, so but that's I'm like, and there's not much more to currency exchange than what I just discussed here. There's not much more to it. Okay, so that's why and again, we don't the 6 transactions that we're engaged in. Okay, we're not doing them because of exchange rates. Okay, so also just to paint the real picture of what's going on here. Now, if there's some dramatic change in currency rates, exchange rates that makes us see an opportunity, but the world is set up for that not to happen. Because that's a loss of confidence in the European currency or a loss of confidence in our currency. That's generally a bad thing, and that's generally something you don't. I'm not saying you don't want to take advantage of that, but you don't want to see it. And the governments aren't the governments in Europe and our government aren't going to let the exchange rates go. It's not just the Wild West where they could just be anything. Okay, we're certainly not going to see that. And also, I remember a currency trader that I met a number of years ago. He made his computations to 4 decimal places. So if you're going out to 4 decimal places, you're looking for very fine variations, and I think it's measured in bits or something like that, like 100 bits or blips or something. There's a terminology. So instead of saying 0.0135 or whatever, instead of saying something to 4 decimal places, you just use it in blips or bips or whatever it might be. And there's a conversion chart for that also. But again, it's really nuts. I'm not a trader. Okay, I'm an investor, and I'm an economist. I analyze aggregates and I analyze companies. I advise people with capital, how to deploy that capital, and then I analyze those ventures as we go along. That's what I do. I don't do everything. I haven't worked under every. I haven't had every experience out there. I've never been an accountant in an accounting firm or a trader, whatever, on the New York Stock Exchange. I've never done anything like that. Okay, my work is investment analysis, securities analysis, and that's what I do. So it's a singular thing that I do, and I give you all the. And again, you're learning from my experiences. You take someone else with another class with other experiences, you learn from their experiences. But with me, you're just learning from my experiences, and my experiences are what they are. Okay, so anyhow, we were here. So it says dividends. Now, there's a couple. We're not going to talk about it today, but there's dividends, and or dividend income and bubbles, and we're going to go through textbook discussions of that. Okay, so it says dividend stocks are core to Berkshire Hathaway's portfolio, which is expected to generate about $6 billion in cash. So I think this is not a bad guy to follow what he does. Okay, and I basically do it warm. Now, maybe not as successful, but I basically do it warm. And Warren Buffett does, or I think like Warren Buffett thinks. Okay, generates dividend income, generate dividend income, however, whatever way you may do it. Now, you guys probably weren't born when he made these investments, and let's just sort of slide to the bottom here. And I have another media account that discusses the same thing. Berkshire Hathaway is Warren Buffett's company. Okay, and it was named after a New England textile like a cotton manufacturer. The company made linings for the inside of men's jackets and probably women's apparel. Where if you look at a suit jacket, it's not just the material. There's a cotton lining inside. And when I get my jackets made, I get different colors, and you got to have your name put in there, and all sorts of things can be done. And at some point, hopefully, you're able to do things like that. It says Berkshire Hathaway is expected to get dividends in the various stock holdings. Now, based on the percentage of shares that Berkshire Hathaway owns, they're entitled to $1 billion worth of Chevron's earnings, almost $1 billion of Bank of America earnings, almost $1 billion of Apple's earnings, almost a bit, 700 million of Coca-Cola's earnings, and about 500 million worth of Kraft Heinz, which is a venerable Pittsburgh food processor manufacturer in Pennsylvania. Okay, so if you hit all of those up, and there's another article, it's about 6. It's actually about 6. This one says it's about 5. I think there's some other petroleum company came in there and integrated petroleum manufacturer. And again, what did Warren Buffett look at? What these companies make? They make computers and phones, and two of them are beverage companies or food companies or food products. We made some hamburgers just now. We put some ketchup on them, and every time we make a hamburger, we put some ketchup on the hamburger. I'm not a big Coca-Cola drinker, but I'm starting to say to myself, I should drink cherry Coke. And that's Warren Buffett's favorite drinks. I need to start picking that up when I go to Walmart. I'm a PC user, not an Apple user, but I appreciate what Apple is. Younger kids are very enamored with the phone and the computer and the user interface and things of that nature. And then you have Bank of America, which is a bank, and no society can survive without a bank. And then you have an integrated oil manufacturer. Again, every time you do something, you're driving your car. Okay, and you're putting gasoline in it, which is a petroleum product, which comes from a mine that Chevron most likely owns, operates, and then transports and refines and sells to you and all those other kinds of things. Okay, so in other words, and it'll say it in here somewhere that he bought a lot of the shares that entitled him to these dividends something like 30 years ago, and then pretty much just followed the companies ever since. And after he made those acquisitions, and he was gaining dividends, I'm sure, as he was going along. But the moral to the story is this wasn't currency speculation. This wasn't trading. He became an owner of these companies, and he's entitled to a percentage of the earnings. That's it. Okay, but he made good choices. Okay, and that's what you have to learn. Every kid and every Rutgers here, wherever it may be, has to learn to make good choices. And that's what you're doing here. That's why you're working with me. That's why you're going to college, to learn how to do that. I had a relative, I forget, a number of years ago, her daughter was about to go to college. I don't know, maybe 10 years ago or something like that. And she cornered me in the kitchen of her house one day. And she said something to the effect of, she said, you're a professor and on and on. And, where should my daughter go to college? And I told her the truth. And, and I don't, maybe that was a mistake or something. I don't know. But I told her the truth. I said, I forget her name, which is terrible. Oh boy, it's my cousin's wife. I forgot her name because we haven't spoken in a very long time. But my cousin or his wife. But she said where her daughter should go to college, and I told her what I thought, and she said, I want to send my daughter to technical school, and she could learn to do some technical thing in a hospital, and she'll make a lot of money. But here's the thing, though. When you go to class, you have an interaction with your professor. You have an interaction with each other. You have an interaction with the school. You're coming to class. You're reading material. You're becoming a refined person. That's the whole point of going to college. The whole point of going to college is not just to get job training and that's it. If you come to college and you happen to learn some Excel modeling skills, or you learn about the economy, or you learn some accounting or something like that, that's generally a good thing. But the point is that you're able to have a conversation with people and those kinds of things. Okay, that's why you come to college. Okay, but the whole point of this article is we're going to discuss his philosophy in cornering, $5 or $6 billion a year every year for the foreseeable future, and how he did how he did that back in 1994, which most of you weren't even born yet. So anyway, Warren Buffett has a stock portfolio. It's been, and again, the whole question is, why is this guy so successful? He doesn't use a computer, and I think he probably uses a computer now, but I know what he means. Okay, he's not sitting there looking by the minute, what's the price of Apple computer, or what's the price of Chevron, or what's the price of Bank of America, or whatever it might be, or whatever stocks are out there. And he generally worked in the stock analysis area. And when I worked at Value Line was very good training to learn and understand what somebody like Warren Buffett and Charlie Munger, and I forget some of the other names, Irving Kahn, perhaps, and there were some other big names that started the New York Society of Securities Analysts, which were the interest in that is somewhat waned a bit, and it's been sort of rebranded as the New York CFA society or group or whatever it might be. But it's a professional group, and you go there, and there's I've met people there. I've met some St. Peter's alumni there over the years that have been very successful, and try to build a relationship with them. And you go there to expand your horizons is really what you do. I think Irving Kahn, I think that was the name of the guy. But Warren Buffett, now, okay, everybody says, he lives in Omaha, Nebraska, and this and that. He doesn't spend any time in New York or California, and that's not really true. He did work in Manhattan for a couple years. He went to Columbia University. Okay, he worked in maybe 3 to 5 years, lived in White Plains and commuted, and I think just got tired of the train and the rigors of living like that. Okay, that's not so easy. Another cousin, his daughter just graduated from Villanova, and she got an apartment in New York City, and I thought that was kind of crazy considering she grew up in the suburbs. She's not really a city kid like we all are, but she grew up in the suburbs, and she's working for not IBM, but a company like I forget the name of it, but it's a company like where she's selling enterprise systems and computer systems somewhat at the industrial level. She's not selling them, you know, like a house, you know, per person, which like corporate accounts and things of that nature. But so he got tired of that and went back to Nebraska, and he lives in the house he grew up in pretty much, and it's a short drive to where he lives, and really spent a lot of time reading annual reports, spent a lot of time looking at income statements and balance sheets and cash flow statements and doing valuations, and why shouldn't I teach you the stuff that the richest guy out there cares about, right? I think that's what I should be doing. So dividend stocks or shares of companies that regularly return a portion of their earnings to shareholders, typically in the form of cash. Right there. There's your accounting lesson. That's what a dividend is. Okay, so, and it's in this Wall Street Journal article. Okay, so if you want to, and we do have a formal definition of this, and we'll look at that, and we're not going to do that today. What we're going to do today is talk about this article, and then we're going to do another year of the Tesla income statement, just to get you used to looking at the operating performance of a company and get some feeling for that. It says our shares of companies that return portion. Okay, fine. And it says the majority of the companies that Mr. Buffett invests in pay out dividends. And this, in fact, this year, Berkshire Hathaway, this is the ticker symbol. There's Class A shares, there's Class B shares, and there's different sort of legal rights to having various versions of that. I mean, if you bought shares, and I think he's a guy where he never let the shares split, and the shares went from whatever, $10 a share to $10,000 a share, whatever it might be. Let's look at a share of let's see what the share price of Berkshire Hathaway is. Share price. Read his life story. Yeah, it's $500,000 for one share, and it was up $3,000 in a day. And really, what his company is a basket. It's a portfolio of other ownership in other firms. So as those other firms perform, his company performs. Okay, that's really what it is. It's a holding company. Okay, and that's how banks are held and things of that nature. And I'm sure there's Class A shares, Class B shares, who and what Warren Buffett is. But I just want to focus on that article pretty much. And let's look at the 5-year performance of this. So it was 300,000 a couple years ago. Now it's 500,000. Okay, and it had a little bit of a dip, but not much, and it recovered and had a peak. Okay, but it's pretty. And actually, here, let's look at that. So 535,329. Okay. Equals 535 minus 329 divided by 329. It's been up 60% in just 5 years, 0.62. He's up 60% of the market value of owning shares in his company. You had made 60% just from 2018. Okay. I think that's a guy we should discuss. Bill Gates is a guy we should discuss, okay, in these classes. And we'll find the definitions that are in the textbook as we go along. Okay, so yeah, this whole, I apologize, this red down point. This just means it decreased for the. We don't even need this. I apologize for this being in here. So is raking $5 billion in cash from its stock portfolio, according to analysis of company filings. So again, so it's a publicly held company, so it's got to publish its annual report and income statement and what the company's doing and how much taxes it's paying, how much property it owns, those kinds of things. A fifth of the $5 billion comes from Chevron, which last year became one of Berkshire's biggest holdings. It all produced and increased its dividends for 36 consecutive years, not quarters, years. Also poised to collect more than $700 million apiece from Coca-Cola, Apple, Bank of America, more than $500 million from Kraft Heinz, and roughly $363 million from American Express, according to Dow Jones market data. And again, when you're a public company, a holding company, you got to disclose sort of what's going on with your company. And if you think about it, these are products and services And it's not just a service. Okay, Bank of America provides a service. Apple sells you a computer or a phone. Coca-Cola, you buy a soft drink. Okay. Chevron, obviously, it's a lot of these. So very few of these are all real asset sales. They're companies that produce a real asset. They're real assets themselves and produce other real assets. Kraft Heinz, like I said, we just made hamburgers, right, for the weekend. So we made mashed potatoes, mushrooms, and then hamburgers with cheddar cheese from Whole Foods on top of it. Okay, I didn't include the American Express, but they have the credit card, and it's a credit card, and he likes it, and so and really what it is, it's efficiency of operations, which is why we spend time in these classes going over income statements, and no matter what the class is, if economics class, finance class, accounting class, that's you get a very creatively done presentation of what's going on in the world, and we apply the economics definitions, the finance definitions, the accounting definitions to what we're talking about. Okay, always. That's all. I only can do what I know how to do. I can't do other things. Stock buybacks are just what they sound like, where the company pays the shareholder to buy the stock from it. And actually, Todd Finkel's a professor at Gonzaga, which is a university in, I think it's Washington State. And there's somebody in my class, I'm sure could correct me if I'm wrong. I think it's Washington State. It's another Jesuit school up there. If it's Oregon, I apologize, but I think it's up in Washington State. But Gonzaga was a Jesuit. A lot of these schools are named. Obviously, Loyola is the founder of the Jesuits. And you're here. Hopefully, you learn some things about who that is and those kinds of things. It's important to have some sense of what we're doing here. Okay, it's an important thing. I like to think. So it says where Mr. Buffett has excelled is in choosing businesses that have been able to stand the test of time through many economic cycles. So again, through expanding economic activity and contracting economic activity, expanding prices, contracting prices. And again, we're going to give you the definitions of economic cycles and the business cycle and economic shock, and we're going to do all that. Okay, so it's not just me talking about articles. Okay, we're going to discuss the definitions also, so again, we don't assume you know what a dividend is. We don't assume you know what an economic shock is, or an asset bubble, or what an economic cycle. We don't make any of those kinds of assumptions. But again, I'm applying that textbook, if those textbook definitions, to what's happening today to help you through all this. Okay. I'm always trying to make it look good. Yeah, choosing businesses that have been able to stand the test of time through many economic cycles, raise and in terms of raise their dividends, what they're paying out from earnings to the shareholders, and increase the value of the portfolio over time. So again, the value. I've said it in class maybe a little bit, but maybe I'll say it a little more directly here. My one customer is the son of a rather large financial empire in New York, Pittsburgh, Naples, Florida, and many other places. And when you're the son or relative of in a wealthy family, you go out into something called your family office, where basically you're managing your part of the business. And I help Mike do that. I give him economic advice and talk to him, and just have, almost like with you guys, just have a conversation with him about what's going on. And and maybe I'm a little too much, and I've been accused of that at work, and probably even with you guys a little bit. Maybe some of you, I know we just started here. Maybe you guys are going to accuse me of being too much in the sense of just saying too many things about whatever. But I'd rather oversay it than undersay it, than we have missed something. So, and it says here's something else. It says the company has 120 billion in cash equivalents, according to its latest earnings report. Yeah, so this is okay. This is not the value of the stock portfolio. This 120 billion. This 120 billion is. It says cash in terms of the liquid currency that can be used to acquire other. You could buy a lot of. You could do our deal. What we're doing now. You could do our deal. probably 200 times or 300 times or 400 times over with that amount of cash. Okay, we're about 1/500th of in terms of, and I don't even think what we're doing is completely cash either. And we're also going to talk about equity financing, debt financing, which is also playing a rather large role in what I'm doing, outside of the monastery, right? At St. Peter's, the monastery. So the monastery. Anyway, investors will have a chance to hear from Buffett on Saturday when he talks. So yeah, actually, this is his convention in Nebraska, where a guy from Rutgers went to this. It's like going to see the Rolling Stones or something. I don't know if they have music there, but it's in an arena now. I'm sure it used to be in a office convention center or a meeting room at maybe the university or something like that out there. But now it's expanded to like the Prudential Center or the Barclays Center in Brooklyn. He'll go there. He's on the stage and everybody's just wrapped listening to him, and he'll talk for 5, 6, 7 hours answering everyone's question. Okay, and that's where I get my my attitude towards questions, where I'll answer all the questions that you guys need to ask me, and there's no limit to questions. I'm not unhappy that you ask questions, and I know maybe some people are. It doesn't bother me. I want to hear from you. Email, whatever, live in class. Email and live in class are the two best ways to communicate with me. So anyway, he's at the convention center there. Thousands of people attending, and he typically addresses a variety of topics, including the economy, philosophy, investing, and sometimes recent investments. Okay, and a lot of those meetings, if you just go to YouTube, they're there. All right, they're there, and you can listen to them and all that. So, and as we're sitting here. Let's see what I can do for you. Yeah, 5 hours, 7 hours, 44 minutes. And these are recent. This is not when he was 30 years old. This is a couple years ago. All right, so these are not from long. This is 2 hours. This one. Okay, this one's only 13 minutes, but they're long. Like I said, you have to dig for them a bit. It's when they're sitting at this table. Okay, it's when they're sitting at that table. So, and sometimes it's just a snippet of what they're talking about. And see, here's people waiting to get in. See, it's like an arena. It is like it is an arena. It is available for sale. I love that. Available for sale. That's cute. That's cute. But I know they're long. They're not short. And here, let's. And he loves. And he may own something. Warren Buffett annual meeting. He may own a part of NBC or something like that somewhere. Maybe not his top holdings. See, this one's 7 hours. If you it may not all be on YouTube. Also, there's other video platforms besides YouTube. Okay, but we're going. Let this thing figure itself out here. But we'll get back to that. So. Yeah, so dividend stocks are appealing to many investors because they offer steady payments, like bonds, which have a potential to deliver much bigger returns if the share price rises. Now, he's been able to, come to a legal agreement with these companies, regardless of, common shareholders, to say, hey, I own 10% of your company. I deserve 10% of the earnings. Excuse me. So he's been, in spite of having a lot of shareholders. I prefer, and I've recommended this on our transactions, that we keep all of our ownership private and just hammer out a legal agreement is, percent, who's entitled to this percentage, who's entitled to that percentage, those kinds of earnings, and, when the wire transfers are going to happen and things of that nature. So I would prefer that to not have, the masses, sort of right there. I sort of prefer that. So steady payments and bigger returns. Now that's if you're entitled to earnings and you get a dividend, that's it. Okay. And it says bigger returns if the share price rises. That's a preferred stock. is what that is. And this guy may not be saying it, or maybe it was set up here. We may have missed it, but I doubt it. A preferred stock is something where you're entitled to the appreciation of the value of the company, plus you get a steady dividend. He's known for that, for using that type of ownership instrument. He's certainly known to. It says they enjoyed a period of outperformance at the start of 22, when nervousness about the inflation sent investors fleeing many other parts of the stock market. Fleeing many other parts. Okay, and coming to Berkshire for safety, like a bond. But now you could do pretty well, folks. If you're liquid now and you've got some cash, now's a very good time to get some, and make the deal for a long time, 30-year instruments, that kind of a thing. And it says, like everything else in the equity market, dividend stocks still carry risks. Companies can cut back or suspend a dividend if they face a cash crunch. They can cause their stock prices to fall. So yeah, compared to bonds, a company could curtail a dividend with a bond payment. The payment is the payment unless the company goes bankrupt or ceases operations or something like that. And it says that can cause the stock price to fall, since investors often interpret a company's decision to suspend a dividend a sign that's running up against significant financial problems. Dividend stocks tend to underperform when investors gravitate towards more relatively high priced growth stocks, which has been the case. So in other words, when you got a runaway stock market a bit, the dividend paying stocks become less appealing because people feel they can get a better it's a better bet to just bet on price appreciation of highly traded companies, or companies where there's a lot of interest in those. Berkshire Hathaway's been around forever. People consider it boring, but folks, when it comes to money, I like boring. I like boring. So dividends aren't the secret sauce, but they're part of it. Berkshire finished buying its roughly 40 million shares of Coca-Cola. It currently owns for $1.3 billion. That year, Berkshire got $75 million in cash dividends from Coke. So so 94, Berkshire spent $1.3 billion to buy 400 million shares of Coca-Cola. That's what they did. Now here, let's check our numbers a bit. So it's 1,300 by 400 equals 1,300 divided by 400. All right, so $3 a share. $3 a share. Share price, Coke. Okay, this was all. So in 94, I don't know what this is. 98, 96. Yeah. But so you can see, even though we're looking at the 94 numbers, $4.88, maybe $5 or $6, he got them for $3, but he probably made an agreement. You're saying, well, wait a second. If the market price of Coca-Cola was $4 or $5, he came in there for $3. How did he do that? That's not fair, right? It's not right. Well, it's a different set of rules in the sense where he probably committed for 30 years and said, hey, I'll give you 1.3 billion. You give me 40 million shares, which comes out to a discounted price, but I'll leave my capital in there for 30 years. So that's probably what he did. And then that particular year, he received 75 million. Okay, so the first year he received 75 over 1,300. So he had a return of about 6% the first year. All right, 75 million divided by 1,300 million, or 1.3 billion, is about 5.5%. And then 30 years later, and I should put some of these in there. That's what is that? The yield? Let's check that out. Yeah, the dividend. Yeah, it's the yield. That's the dividend yield. So here, let's do that. Let's do. or thereabouts. So the dividend yield equals the dividend divided by the well, really what you paid. That's really based on what you paid. It says stock price. If you look at the definition, it'll say stock price. Price per share, dividend per share. And actually, you know what we'll do? Since this is really important, we'll do this. Copy, paste. Oh, and it's 8:03. So yeah, we'll discuss. Yeah, that was a part of my notes from last summer. I worked on these notes, and it's good. And like I said, as we go through this, I get a better sense of things. Like a financial ratio showing the return would earn from investment based solely on dividend payments. Okay, so like I said, so we have our, and actually what we'll do with this, we're gonna take this, cut, and we'll get to that at some point. Okay, right there. Yeah. So there's what his yield is in terms of what he paid. You know, he paid, 1,300 million and got 75 million in cash thereabouts. So his first year will be 5.77%. 30 years later, he's getting 704 million dividends from the beverage maker, and the value of the stake had swelled to 25 billion. So, in other words, from the 1.3 that he paid to 20, that's almost 20 times of a change. And in terms of, again, the sort of the new dividend yield, the dividend yield now, whatever it's 30 something years later, he's getting 704, 25,000 million. This may be dramatically lower, but don't worry about that though. Okay, that's okay. Yeah. So right, so 25,000 million. So 704 divided by 25,000. Yeah. So don't oh the dividend yield is down. Okay, don't worry. This is about 2.8%. 82%. Don't worry about that though, because your valuation went up 20 times. All right, your dividends went up about 10 times. Right, if you look at this, right, the 704 relative to so the change here. So right, 704 over 75 also equal 704 divided by 75. Yeah, it's about 10 times bigger. The beverage maker. So your dividends increased by about 10 times. The value of your company increased by about 20 times. And you say, oh, well, my yield is half. Something's wrong. Something's wrong. Well, there's not something wrong. Okay. It's fine. Okay. It's okay. All right. So you're good with that. And like I said, we care about the definitions and it's good. And now in terms of, in terms of what that really means, in terms of all the courses. So the 410 and the 401, this would be this would be content in those particular courses. But this is general interest to economists. And let me tell you that the biggest mistake you can make to study economics and think that, well, accounting doesn't mean anything and the finance doesn't mean anything, and I just want to learn about the different economists, Maynard Keynes and whoever else you want to list in there, and that's a big mistake. Okay, that would be a really big mistake, because everything that's done in terms of the practical work of financial economics is done in terms of accounting. Now, I'm on an acquisition team, is what I'm a private banker, but I'm on the acquisition team, an economic analyst on top of it. But everything we do is accounting based. What I do now, there's people who do very academic work, and it's all statistical analysis based. It's all just columns and numbers and years and time series, and we're looking for patterns and we're looking for relationships between this variable and that variable and whatever it might be. And that's all well. I mean, I could have worked like that, but I didn't. Okay, but I could have worked that way. So yeah, so what's happened? So you can see how much the dividends have changed. You can see how much the value of his, whatever it is, 400 million shares, and who knows if those shares have appreciated. But at the end of the day, you don't put shares in your bank account. You put US dollars in your bank account. So he went from a $1.3 billion investment 30 years later to 25 billion. And actually, what we could do, we could put it into this formula, right? So what are we, 94, 04, 94, 04, 14. So yeah, we'll do whatever that is, 29 years, I suppose, 29 years. We'll copy this, paste. This is 9. And we're going to look at 1.3 to 25, right? 1.3 to 25. So this is 25. This is 1.3. So yeah, so he made that's about 11% change a year, which is, I think any of us would take that. Okay, so we did a little extra analysis relative to the Wall Street Journal article, which is not in there, because then they'll never do this amount of math in the journal. They'll never. So the U.S. Department of Commerce might, but the Wall Street Journal will never, because readers don't understand and this and that. So it's all that. A year for 29 years. Yeah. But that's how, so it's this thing. Remember this? I showed you this formula. Where is it? The rate and the future value of the present. It's this thing basically, right? I showed you that from last. Again, that's the 401 class has that as it's material in there for what it's worth, that it's in that particular class. So growth occurred every year, just like a birthday. Okay, and that's his big thing. In other words, Coke sold more sodas, Chevron found more oil and natural gas, sold more oil and natural gas, refined more oil and natural gas, transported more oil and natural gas, Apple sold more phones, Bank of America provided more services, collected more fees as a bank for loans and traded on its own account. So you're seeing all the different ways that these banks produce revenue, and at a cost that had the enterprises make a profit. Okay, Warren Buffett's annual letter, his annual letters for the last 6 decades are, there's a professor at Yeshiva, which is a law school. It's a Jewish university. It's a law school in New York, and there's a professor there who wrote about Warren Buffett's letters and is updated it, and there's a course. There's a course in Warren Buffett's letters. Okay, at Yeshiva, I think it is in the law school. Charlie Munger's Warren Buffett's attorney, and he's a billionaire also, but not. Buffett's a $100 billion value net worth guy. Munger's like 2, but do you think Charlie Munger's unhappy that he was worth only $2 billion? Probably not. Okay, probably not. Maybe he is. I don't know. But considering Warren Buffett's so much more wealthy, so expect the company to continue to pay out bigger dividends in the future. The amount of good reason to believe that this will be the case in Coke. So yeah. Also, your projections, and this is what's predictive. And this, let me tell you what's not going to help you do this. What's not going to help you do this is some statistics. That's not going to help you figure this out. In other words, how much soda Coke is gonna sell, and how many loans, how many more loans Bank of America is gonna have fees that they can collect on, and things of that nature. A statistical equation is not going to do it. You got to have a sense of the business and look at the annual percentage changes, and you need to just project out yourself. You can do that for 10 or you don't need an equation to do that. You can just do it year by year. If it's 10 or 15 years, then that's a lot. At Value Line, they would say never project more than 3 or 4 years. Okay, so if you're projecting out 10 or 12 or 15 years, you can do that. When I say by hand, you don't necessarily need an equation that makes it. And actually, I've seen models where it's just a step, where it's just people guessing, sitting around, people in the industry sitting around saying, well, we think this year will be 10%, we think next year will be 12%, and we think it'll level out at maybe 11 or 12% or whatever it might be, when the consistent growth is going to happen and things. So it's not necessarily the biggest, baddest statistical equation out of Rutgers. It's that may not always be the case, but they're going to make some prediction based on their experience of what they think that the earnings and the dividends of these companies are going to be, and for American Express and the rest of them. I did not work at the American Express. Oh no, I did. What do we have here? He bought shares in 95 for 1.3 billion and had 41 million in dividends that year. Okay, so let's look at the dividend yield there. Okay, so we have 41, and he spent another 1.3. Okay, is what he spent. So now this will be lower than what we had before. 41 divided by 1300 equals 41 divided by 1300. Yeah, about 3.15%. Again, none of this is going to blow you away. And this is not the only measure either. Okay, again, you don't put percentages in your bank account. You put dollars or euros in your bank account. So Berkshire's stake in the company was valued at 22 billion. So that's almost 17 times. So what I did was I divided, 22 divided by 1.3, and it gave me almost 17 times. And they received 302 million in dividends. Again, almost 30 years later. This would be 28 years. So the next dividend is there, and we'll do that. So this was 302. Okay. 22,000. So 302 over 22,000 million. Yeah, so that's 1.37%. Yeah, so it's even low. So again, you can't see. So again, so if you're looking in a finance book, you'd say, "Oh boy, big problems here," but not really, because his stake grew 17 times in 28 years, right? His stake grew 17 times, and again, let's get the change. The percentage or annual. So again, we have the little formula sitting there for us. Stake in the company. This is 28 years. So we're going to do 22 and 1.3 billion. All right. That's also about 11, believe it or not. So again, so he engineered these out for a good 11% annual return. Again, not bad, not bad, right? And you're talking 7 now, but also the time. Anything with geometric math, the time is in the favor of the computer to the more time you leave the money there, you're going to get great expansion of that. So again, not bad, 11%. And again, that's all corporate finance computations. Dividend gains, though pleasing, are far from spectacular. Buffett said in his letter, but they bring with them important gains in the stock price. So again, if he's talking about stock prices, he's a preferred shareholder and all this other stuff. So, so he made that plus yet a relatively big appreciation. If there's a way to compute this where you look at the dividend and then you add the capital gain in there plus the dividend and we need the spreadsheet to do that particular math. But we looked at the dividend yields here. How would we do that? Let's see. So you could, if you knew the price, the value changed at 11% every year. And then you got dividend. You kind of, and then you can convert that into. So yeah, we could have made a model, but I don't want to do that on the back of an envelope. But we'll sit down in the Excel and we'll expand these out a little bit better, and we can do something where you include the capital gain plus the dividend yield, because this 1% and 3, this is just simply based on dividends. You could see you have I'm not saying you can add the 11% change in there. But I mean, maybe theoretically you could just say 11 plus that 1 gives you 12%. You could say that, just in terms of a rough computation. Okay, it says important gains in the stock price. It says it right here, important gains in the stock price. Berkshire didn't choose to reinvest the dividends it received from Coca-Cola, American Express, back in stocks. Won't come away that many investors end up raising their returns over time. Did not do that. Berkshire wanted the dividends annually. They didn't reinvest it. We'll buy more shares. We'll own more of your company. They did not do that. If its stake in both companies has increased over the years from buybacks. Well, yeah. I mean, if there's less shares out there, and then you own a fixed number of shares, and then all of a sudden there's less, so you're dividing earnings by fewer people. So yeah, that's another maybe deal you can make with the management. Though we'll front you some capital to expand your business, and promise us you'll buy back shares from other people, and you'll decrease the divisor, so we get a bigger hit from earnings. Okay, they could have made that deal too. So Buffett hasn't publicly commented on why he hasn't bought more Coca-Cola, but his followers have theorized because of his aversion to overpaying for investment. Well, yeah, once it started appreciating and a big chunk, and also there's something with filing where once you're past a certain percentage of ownership, you've got to do more disclosure, and people like this tend to, if you're a holding company, you want to hide what you hold as long as possible, and you don't want people who are in the know to look at the government filings website and see what you're invested in if you don't want other people to know that. Because as soon as somebody else knows that you're interested in something and you're successful, all of a sudden either they're going to try to cannibalize it, or it's going to have an effect on the price or something of that nature that might be adverse to what your interests are. So that's something to keep in mind. Too high a price per stock of an excellent company can undo the effects of decorated for. Yeah, for business wrote shareholders. Yeah, so that's a comment that Warren Buffett made in '83. So even though you bought, you have an excellent company, but if the market price is very high, for them it's a pass. They're not going to overpay for something. And that's an important piece of the puzzle. Coca-Cola stock is $64. Okay, well above the $10 or $12 it traded at in the 90s. So yeah, we looked at it, and what was it, 6 or 7 or something? But still, if it says okay, well above the 10 or 12, I don't know if it was 10 or 12, but he's saying that it is. But we looked it up. It seemed to be 5 or 6, but okay. So maybe the end of the year it was 10 or 12 or something like that. But you can see. So if he basically bought it for $3 a share or thereabouts. Right. So if you look at what he bought it for here, he bought, what did he buy? Yeah, he bought 400 million shares for and whatever, $3 a share, something like that. Let's say 3. It's probably a little bit more than that. 3 and a little bit. Okay, so yeah, so he got it at below. But again, what the deal was, he was going to leave the capital in there. He did get a great deal on the stock, Mr. Finkel said. Okay. So that was that. So now, like, as I promised, I want to just roll over to, and we already did some Excel stuff today also. We already worked on Excel a little bit. That was just we just sort of scratched out a couple inches there. What I want to do, yeah, all this stuff you don't need. We're going to do another year here. Okay. I want to do another year. And here we're going to show you some modern, the Jeremy Grantham hazards of asset. Yeah, I mentioned at the beginning. Okay, so we'll worry about that another day. So what was it? 49 had the financial statements on it. Yeah, we remember page 49. So we'll do 2021 now. So again, we're just and notice from 2020 to 2022, almost certainly more than double automotive sales, right? From 24 billion to about 67 billion, and 2021 is about 44 billion. Okay, so let's work on that. So, and actually, what we can do here is, and I've mentioned this before, let's keep everything sort of horizontal. All right. Okay, so automotive sales, 44 billion, 125 million. We combined, again, the regulatory credit, which is the government subsidy most likely, and then leasing. There's some fees from leasing that they picked up. We're going to make that a dark font. And this is just, again, this is just a summation of sales, leasing, and the regulatory credit. So equal sum, and it's got to be the array I9 colon I10. Now, again, I know I speak in computer sciences, but when I was at Rutgers in Newark, physics, math, computer science was all sort of in the same building, and I was very fortunate where I was able to participate in all three of those areas. So I did teach some computer science courses. And so total automotive revenue about 47 billion compared to 71. Now we're just doing what the accountant does and just sort of listing everything. But when you're an analyst, you want to look at percentage changes, dollar changes, those you want to do a little historical analysis in that vein. And as we read about Tesla yesterday, they have an energy generation business, they have a services business. Okay, so the energy generation would be 2789 and services 3802. Okay, so their total revenues are about 53 billion compared to 81, but still that's a nice change. Let's look at that percentage change. Right, that's about 50. That's about a 50% change. Okay, that's about a 50% change is what that is. All right, because it's up about 26, now more, 21 and 28 divided by the 53 is about 50%. And again, this number, this is just the summation of the four revenues. See this? Just make this a little bit bigger. See what this is? This is the four revenue lines. We added them up. Okay, so you see again, so you have a little bit of experience with Tesla and looking at folks, this is, and so again, so there was a guy who asked me this question in my last class on Thursday about why we were doing this or whatever it might be. The only worth it thing for me to teach you is analysis. Okay, you can learn the rules of accounting somewhere. Right? If you want to learn the history of different economists, you can do that. Okay, but being an analyst it's there's not a lot of people who can teach it. There's not a lot of people who can do it. So it's a high level skill, and to dispense that to you guys, I think is a pretty it's a useful, valuable thing to have happened. Okay, so when you have the revenues, then you have the costs of these revenues. It costs 32 billion to sell the cars. The leasing part of this was 978. Okay. Storage 2918, 3906. Those are services. their body shop, or they're servicing the vehicles. So they spent $40 billion to run the company. So they turned the $40 billion into $53 billion. So they paid $40 billion, they got 53 out of it. So that the gross profit is there. And again, if you want to look at and really, we're not necessarily going to do it here, but maybe in the future we can. With the gross profit margin. So you have a 25. So in terms of the revenue, you got 25% left. You spent 75%, you got 25% of the revenue left. That's that 13 billion. And this is just you're subtracting. You added the 4 revenue lines, you subtracted the 4 cost lines, and that's how you got the 13 billion. And then there's a couple extra lines here. What are we doing? So this is 2593. When see, and here, let me go through why this is what this negative means, and a lot of other stuff. Research and development, he spent about 2 billion. Selling, general, administrative, those are overhead costs. That's about 4.5 billion. And restructuring, so maybe there was some kind of benefit. The 27, you see how these are expenses? That 27 comes out of it. So that was some kind of credit is why. So for whatever, we have to look in the notes as to why that was, but just interpreting that. So see how you have 7 billion in operating expenses. So now the total, well, that's just the total. That's these expenses is what that is. The next line is going to be profit or loss. So I went big with this. So I just said, okay, we'll add these 4 lines. We'll subtract these 4, and then we'll subtract these 3. And that'll give us 6 billion is left. So we double that profit the next year. So this is half of what that was. Earnings before interest and taxes, that gets worked up from the bottom, and we'll get to that. Okay, we will get to that. Okay. Interest income is 56 million. No, pardon me, 56 with an M, 56 million. Expense, they spent 371 million. And the net of just other incomes and expenses this year, it was a positive. In 2023, that was a negative. We lost that. Okay, so the profit or loss before taxes is just, again, I went big with this and just did everything. So added, subtracted, netting those out, and then that was negative. So yeah, no, also these just netting these out. So now you're down to about 6,343 million. The provision for the taxes, 699 million. That was for the taxes. So the net profit loss was about 5.6 billion. And this other number here, so we're going to go through the non-controlling interest. So those guys were entitled to 125 million, which was there. Okay. So the shareholders, what they were entitled to, we're subtracting these. They were entitled to about 5.5 billion. Okay. And then in terms, so again, looking at this number, you're just subtracting net profit minus this. These are the per share numbers. So we need the number of shares. Oops. Yeah, there's your per share numbers. So this one's going to be, here, let's do it like this. This will be 2959, 2.9 billion shares, 3386 billion shares. And we'll get to the depreciation in a second. So now, right, when you divided, you took net profits divided by basic weighted average shares, diluted. We discussed what these shares were yesterday. Diluted means we're anticipating more shares being created to compensate employees or whoever. There's holders out there where there's contracts where the potential dilution is going to be another whatever 400,000 shares or whatever, actually 400 million shares, right? Because this is billions. This is 3 billion, 2 billion. So another 400 million might be out there. So you divide earnings, the same earnings number is divided by both of these, right? This one is going to be that earnings divided by 2.9. This earnings divided by 3.3. Okay. And then depreciation is on the cash flow page. Find that. $2 billion 911 million, right? 2 billion 911 million. So this is 2 billion 911 million. And again, looking at what we did here, earnings before interest, taxes, depreciation. So you took this and added back depreciation, right? So you took earnings. Actually, here let's do earnings before interest, because this is built up from the bottom, not from the top. I don't know why is it two add tax. I don't know why I got two of them in there. Add tax. I don't know why I did that, but there's a double. So what do we do here? Here's taxes, right? And then you did yeah, it's not just taxes. You did, what did you do here? You added back taxes. Yeah, and then the other thing is interest expense. Yeah, how about that? Edit note. Yeah, so we added the both of them back. So what do you took net profit, you added back taxes, and then you added back your interest expense. Okay, so, and there's people out there in New York that want to make this computation, but you can see it's not dramatically different from profit losses from operations. Okay, the reason these are different is because you have interest expense and interest income, and you have some other income numbers here. Okay, that's why these don't match. Okay, usually profit loss from operation would generally match, but you have some other non-operating numbers that are in there that sort of get in the way, pretty much. Okay, but that's all right. But that's, like I said. But you could, this EBIT stuff, the analyst community likes it, but I'm always happy with operations. I'm happy with that. Okay, so, and then earnings before interest, tax, depreciation. I just took EBIT and then added back depreciation, which is a non-cash expense. Okay. And again, but this EBITDA thing is it's way bigger than this, and you're almost making a cash flow out of this. Is what you're doing, and might as well just use a cash flow then. Is how I see it. Okay, I don't know if Warren Buffett is an EBITDA guy or not, but these are sort of non-GAAP measures that you're not going to see. I like the accounting rules and follow the accounting rules generally. Okay, so we did this again. Okay, so we messed with this one more time and showed you guys where the annual report was. So again, so just get some comfort with that. And again, I mean, you can look at you can look at an international company if you want, but it's going to be in euros or some other currency, and you got to convert it, and it's just for the ease of teaching these classes. I prefer just using a Tesla or something like that. And believe me, he sells internationally, he produces internationally, so it's as much of an international company as, and the Japanese companies have operations in America and things of that nature. Okay, so again, you got your second lecture here. All right, and So, keep up with these things. Try the Excel examples, read through the Warren Buffett articles. And what I'm suspecting we're going to work on next time, there's another Warren Buffett article that we can look at. Okay, so that's The Motley Fool, which is an investment website. And then we have some of these other, we have a bubble analysis, we have what dividend yield, we have those kinds of things, and capital gains versus dividend stocks, and we have all those kinds of things. Okay, so like I said, we're trying to make the most of our time together, and I'm trying to give you a nice spread of macroeconomics, microeconomics, and I realize some of the classes, a little more advanced classes, and things of that nature, that kind of a thing. Okay, folks, thank you.